Okay, guys, so we are starting with chapter 1, financial accounting. Again, if you have questions, you butt in, okay? Um, Financial accounting talks about what we call it's the language of business. Financial accounting is a way we gather information about a company and we express it in a financial statement or financial statements so the end user can learn information about a company. Business. What is a business? A business is an entity in which inputs such as material, labor, expenses are assembled and processed to provide goods and services to customers. Think about this school. This is a service. You're receiving an education. So Anoka Ramsey, in order to provide that service to you, an education, hires faculty, pays utilities for this building. Does that make sense? Has insurance, all kinds of resources in order to provide the service of an education for you. I have a CPA practice, that's a service. But think about Home Depot or Target or Walmart. They have inventory, they have employees for you to be able to purchase products. Make sense? That's a business. Profit is the difference between the amounts received from customers for goods and services and the amounts paid for the inputs used to provide the goods and services. It's the net, it's the difference, right? There are, generally speaking, 3 types of businesses that operate for profit. Now, guys, this school does not operate for profit. Some colleges do operate for profit, but this is not the purpose of operating for profit. There are service businesses that provide services rather than products to customers. Can you guys think of a service business? Haircuts? Yes. Catering. Airlines. Okay. Retail businesses sell products they purchase from other businesses to customers. Target, Walmart, Home Depot. Anyone else? The auto stores. What's that auto store? I always get it confused. You get O'Reilly. But manufacturing businesses change basic inputs into products that are sold to customers. Can anyone think of that? Coke Refinery, Pillsbury, 3M. Do you guys get what I'm doing? They're making the products and turning around and selling them. So guys, which of these would be a service industry? A service business? Walmart, Southwest, Ford, or Starbucks? Southwest, yes. Business activities. All companies engage in 3 types of activities. They can have financing activities, which is a way of dealing with investors and creditors, getting money to fund the business. They can deal with investing activities, purchasing and selling long-term assets. Okay? Or operating activities, which is what most of the transactions involve. Those are the day-to-day primary operations of a business. So every transaction or activity a company does will fall under either financing, investing, or operating activities, with most of them being operating. Financing is going to be issuing stock or taking out loans. Yes, dear.
Is this slide going to be on
D2L? Absolutely. It's on D2L and the lecture will be on D2L. Financing activities is borrowing money or getting stockholders to invest in a company. Investing activities is the purchase and sale of long-term assets, buildings, equipment, trucks. And operating activities is most of it. It's why the company's in business. Receiving cash from customers and paying expenses. So basically, accounting is all about providing information for people to use in operating a business. Accounting provides information to other users, not just managers, but other users, to see, do I want to lend that company money? Do I want to invest in this company? Do I even want to work for them? If you think a company's getting ready to go out of business, do you want to work for them and not get paid? Make sense? Accounting can be defined as an information system that provides reports to users about the economic activities and the condition of a business. Any questions before we move on? So, what are we doing? Ultimately, what we're going to do is we are going to look at these various activities and we're going to measure them. So we're going to take these activities, or what we call transactions, that a business performs, and we're going to measure them. And we're going to decide, okay, where does it fit? So activities that are related to resources of a company, we call assets. Resources of a company could be cash, could be buildings, could be supplies, could be inventory. You see, resources. Resources are things that help a company operate. There's another activity called amounts owed, or we call it liabilities. When you borrow money from a bank, don't you have to pay it back? So liabilities are a benefit today that require a future sacrifice, meaning we might borrow money from a bank of $10,000. That's going to help us today, but don't we have to pay it back? Don't we owe somebody something? That's a liability. A stockholder investment, we call stockholders' equity. What that is oftentimes we'll have people that want to invest in a company and they receive stock in turn for giving them money to a company. That is the stockholders' equity section. No, this accounting equation we're going to talk about at length. Assets equal liabilities plus stockholders' equity always holds true. Assets are resources of a company, and those assets will always equal liabilities along with stockholders' equity. Distributions are what we call dividends to the stockholders. Stockholders invest in a company, but are they just investing because they want to give you money? They invest because they want a return on their money. Does that make sense? So distributions are dividends that are given to the shareholders. Then we have another piece, revenues and expenses. Revenues happen when you sell products or services. So when I go into Home Depot and spend $300, that's revenue for Home Depot. When I go and get my hair cut and I give them $150 because I get it highlighted and cut and everything else, those are revenues to that company. When someone pays for a tax return, those are revenues to a CPA company. Does that make sense? Revenues are selling products or services, and expenses are the cost of providing those services or sales. So for example, for me to provide a service of a tax return, I need software, I have rent for my office, I have employees, I have education, I have insurance. Does that make sense? Those are all costs I have to incur for providing that service. Make sense? So we look at accounting as an information system. We have various people that utilize this information. We can have people from within the company that need this information, and we can have people from outside the company that need this information. Financial accounting, generally speaking, is providing information to the external users of the business. Why do I say that? Because the information is big and general. People from within the company will want specifics for a certain department, which is managerial accounting. How many of you need to take managerial accounting in the future? Okay, that's accounting, but it's providing information for people within the company. Financial accounting, for the most part, is providing information for those who are trying to make decisions outside of the company. Accountants have to be ethical, so the information they provide users is trustworthy. Ethics are moral principles that guide the conduct of individuals. Businesses, managers, and accountants can behave in unethical ways, and there are consequences when they do that. So, no, ethics is an important piece of all business, and you're also hearing it in accounting. Why? We have had so many issues with unethical people and behaviors. It started years ago with Countrywide, which was a mortgage company, Enron, which was a big oil company and energy company, Goldman Sachs, Wells Fargo, Xerox. Guys, I mean, as long as there are humans in this world, we're going to have unethical and ethical people. But our goal is to provide an ethical accountants, so we provide good information to end users. No. How many of you guys are going into accounting? No. I mean, of course, I'm biased because I love accounting because I've been in it 39 years. Well, I've been in it since 82, but I've been doing income taxes for 38 years. But honestly, it is an awesome field to get into. There's been a decline of accountants entering the field, and as a result, the demand has become so high. So accountants, it just kind of just shows you various income levels here. I just was speaking with someone who's been a CPA for 3 years now, and his salary is already $110,000. So the pay is good, but for whatever reason, the accounting has declined in recent years. So no, I mean, the starting salary they say here is 50. Actually, I have an employee and she's not even a CPA and she's already getting 75,000 a year. You know, it's just, it's all about supply and demand, isn't it?
I got a question.
Yeah.
Is accounting really a sustainable career in the long run?
Accounting, I mean, I think AI is changing everything. The problem with AI is you have to trust what's being input into it. You know, and so AI is changing our world. Guys, back 100 years ago, I'm not trying to get away from your question. I'm just kind of going back and saying, do you remember when there was industrialization and we got the assembly line? Everyone was freaking out 100 years ago that we were changing the way businesses worked. When we got computers, everyone's freaking out that it's going to take away businesses. AI now is a huge freak out, but guys, it's here to stay. We have to find ways to work with it. So I have been enlightened with AI and ChatGPT and Copilot and all those things. It's amazing how it can help me write letters. I can throw in all my PowerPoints and it can give me 2 pages of notes for you. It's amazing. Ultimately, we're all going to use it at some level, but you still have to do the work. AI doesn't allow you necessarily to work through the process of getting from A to C. or A to Z. Does that make sense? So with accounting, probably the biggest deterrent in jobs in the country is um, uh, recruiting overseas people. So someone in the US might make 80,000 a year, where someone in India with the same skills might make 15,000 a year. That's probably the biggest difficulty with accounting, is that AI, as it evolves, and we know it's going to continue to evolve, it may harm. Someone just asked me the other day, can I use AI to do my tax return? I said, well, you can, but like just this year, all the tax laws are changing. Do you trust that AI has all that information? Because where does AI get that information? It's from people. Do you guys get what I'm trying to say? So um, I am by no means trying to discourage AI, but the output is only as good as the input it gets. Got it? Okay.
We don't have a shortage of good accountants. It's just people work over here for cheaper, right? And so we're going to people over here to cut costs.
Mhm.
Okay.
Absolutely.
That sounds interesting.
So for example, I was talking to someone, he works for a big CPA firm and they do use India. I wouldn't do that because I have a small accounting firm and I don't want someone from India getting people's social security numbers and birth dates and their bank accounts. Do you know the trouble I could get into? So I, in my office, won't promote that because it's important to me that I trust everyone in my office because, guys, they could create so much headache. Make sense? Yes.
I have a question. So as a CPA or accountant, what's the main difference of doing taxes for like a household family, uh, or a business? What's the main difference or similarity to that?
Well, totally day and night. With businesses, you're dealing with transactions, like we were talking about. So when someone's got a business, I'm not just inputting W-2s. I'm having to do financial statements to show the income and the expenses and the salary portion and all the taxes. Whereas with a household, you're doing W-2s, dependents, mortgage interest. It's just a whole different animal. Usually you have to do them together because individuals own businesses. So you kind of need to be able to do both. Some people just want to do businesses. I like to mainly do households and about 130 businesses a year, as corporations. On individual households, they oftentimes they do have businesses that you put on what's called a Schedule C. That's all income tax. Anyone taking the income tax class? Maybe you have to have had this class before you take income tax. But so there are businesses on individual household, but they're very different. Okay, going back, guys, GAAP, generally accepted accounting principles, are what guide accounting rules. GAAP is a collection of standards, principles, and assumptions that teach us how we need to report transactions. Accounting standards are the rules that determine the accounting for individual business transactions. And accounting principles and assumptions provide the framework upon which the standards are made. No, in the United States, we have a board called FASB, Financial Accounting Standards Board, that basically is responsible for creating all these principles. So know that we just can't decide, oh, this is how we're going to treat this transaction. We have guidelines to show us how transactions are completed. Investors and creditors, people outside the company, use financial information to make their decisions. That makes sense. The decisions are the financial information is arrived based on generally accepted accounting principles we all need to follow. In the United States, we use FASB. Globally, we use the International Accounting Standards Board, which can be different. Okay? So guys, this first exercise, I'm actually going to move on because I don't want to get behind. But basically, this shows, is it a service business? Is it a retail business? Is it a manufacturing business? What is it? You can kind of go through these slides later, okay? Now, the Security and Exchange Commission is part of the US government, and that has authority over companies that are traded on a stock exchange. Okay, they're public companies, therefore they have way higher scrutiny, and the Securities and Exchange Commission does oversee them. No, this gap is created by the Financial Accounting Standards Board, but the Security and Exchange Commission force people to use GAAP. They work together, okay? The Financial Accounting Standards Board decides the principles and guidelines, and the Securities Exchange Commission, even though they're responsible for those public companies, they do require GAAP in the United States. In the United States, the assumptions, each business operates on its own. So my CPA practice is separate from Jim and Nancy as individuals, okay? Home Depot doesn't file the CEO's tax return with theirs. Home Depot stands on its own from any other companies. We all in the United States operate with a monetary unit of the US dollar. Periodicity means when we present financial statements, we present them over a period of time, generally speaking, a year. Some companies might go March to March because if they're big with Christmas, you know, a lot of service or retail stores, usually that Christmas time is their busiest time. So instead of closing their books in December, they might go March to March. Does that make sense? A going concern means when a company operates, we expect it to continue indefinitely or for sure in the very near future. Does that make sense? So a going concern means it's not going to close its doors next year. Hopefully, Spirit Airlines isn't going to be closing their doors anytime soon, although we're hearing they're having a hard time making it. No. Characteristics of financial information, it needs to be relevant. It needs to be worthwhile so people can make decisions based on it. Faithful representation means the information needs to be accurate. It needs to be true, that it's really reflecting the information of this business. You should be able to compare it. So if I am looking at Home Depot versus Lowe's, and I'm looking at the financial statements, the rules to provide this financial information has to be the same from Lowe's to Home Depot, or else you can't compare it. Does that make sense? Verifiable, it needs to, we need to agree on the meaning of reported items. We need to know what this means. So we have to do it across the board. It needs to be timely. We can't create today a tax or a financial reports for 2023. That's long gone. We need to have it timely to where you can make decisions based on the most current information. And it needs to be understandable, clear and concise reports that help users be able to interpret it. Do you ever sometimes look at something and you shake your head because you don't even know what it means? We need it to be understandable. So, no, everything we talked about here, the monetary means it's going to be expressed in dollars. Time period means it's over a specific period of time. Proprietorships or sole businesses are about 70% of entities in the United States. That's where I was talking about they file them on their own personal return as a sole proprietor or a small business. Partnerships operate about 10% of businesses in the United States. A sole proprietorship is just one person. A partnership is 2 or more people. Corporations, there are 20% of businesses in the United States that are corporations, but they generate 90% of the revenues. So while there's only 20% of businesses as corporations, they're big. Okay? Does that make sense? An LLC is like a partnership. It is 2 or more individuals. Well, there are LLCs that are single individuals, but generally speaking, they're combined with partnerships, 2 or more people. There are some additional principles that we look at in accounting. Measurement principle means we have to determine what amount we record and when will it be recorded and how it will be recorded. The measurement principle determines the amount will be recorded and reported. Transactions between 2 people we call arm's length transactions. So for example, if my daughter has a business and I have a business, she might give me something for really what's not an arm's length transaction, what generally 2 people that aren't related would do, okay? But in financial reporting, we want to record everything at what we call an arm's length transaction. Think of like shaking your hand on something, okay? Historical cost, recording an item at its initial transaction price is called historical cost. What does that mean? When I purchase a building, 20 years ago, that building might have cost $100,000. What I paid for that building is what we show on the books. Today, that building might be worth $1 million. That's called the fair market value of the building. It's not what I paid for it. Financial statements use historical cost, what we actually purchased the building for. That's called the cost principle. Revenue is the amount that we receive from providing goods and services. The revenue recognition principle determines when revenue gets recorded in the books. We're going to talk about that, and that's really important. When is a transaction actually completed enough to show we made that money? Make sense? Expenses are amounts that are used to generate revenues. So the expense recognition principle, sometimes we call it the matching principle, means we record expenses in the same period as the revenues they help to generate. Why do we do that? Well, think about this. What if I, as a company, I spend the big thing are cruise ships they talk about. A cruise ship buys the fuel the month ahead, buys all the food the month ahead, okay? Then they go on the cruise, and after the cruise is done, they pay the salaries. Well, the revenues are when the cruise occurs, let's say the $1 million. The gas, the food, all the supplies happen the month before. The revenues happen when the cruise is going on, and the salaries get paid the month after. Do you see it's important that all these supplies get put along with the revenues, and that the salaries that were paid the month after get put with the revenues, so we match the revenues and the expenses, okay? Here's an example. Guys, I'm not going to do this example because I want to move on because there's a lot more important ones, but take a look at this. This is basically talking about Linda and Eric and how you take personal expenses, but you don't mix personal expenses with business expenses, okay? If there's one thing you're going to learn today that is the most important thing that I don't want you to forget, it's called the accounting equation. Assets, those resources that a company has, such as cash, buildings, supplies, any type of prepaids, trucks, investments, inventory, those are all assets. Assets will always equal liabilities, which are amounts we owe, plus stockholders' equity. Those investments that stockholders have put into the company. This is called the accounting equation. It is so important. Liabilities are shown before owner's equity in the accounting equation. Yes.
Will we go a little bit into owner's equity too for the accounting equation?
Can we go into that? Can we explain it?
Yeah, just like drawing and stuff.
With what?
Like drawing when the owners take out equity. Will that be part of it?
Yes, it will be. Hang in there. You're going a little ahead of me. So no. What you're saying is right, but we're not there yet. So no, assets, which are resources, cash, investments, accounts receivable, inventory, buildings, long-term equipment will always equal liabilities, amounts we owe to people, plus stockholders' equity, which are the investments that stockholders have put into the company. Okay? Give an example of what a company would have as an asset and liability, and then consider what an individual. Assets, individuals and companies have cash. Individuals and companies have buildings, have assets, furniture, fixtures, computers. And individuals and businesses also have liabilities. Debt, meaning money borrowed from a bank to help finance the building. Does that make sense? So here's one problem we are going to look at. The total assets and total liabilities in millions of the Kroger Company and the Procter & Gamble are as follows. They let us know the assets and they let us know the liabilities. Take a minute and tell me what the stockholders' equity is going to be. Remember that? Assets equal liabilities plus stockholders' equity. So take a minute. What would be the stockholders' equity of Kroger? Yes. 9,550. You're exactly right. Because we take the assets minus the liabilities. Isn't that going to be the stockholders' equity? Same with Procter & Gamble. Now, let's look at this. Guys, your homework is similar to this, okay? If we know what the liabilities and owner's equity is, shouldn't we then know what the assets are? So we know assets equal liabilities plus stockholders' equity. So we're going to do that to all of these, okay? Know that an economic event or condition that changes the entity's financial condition is called a business transaction. All business transactions can be stated in terms of changes in the accounting equation. Think about it, guys. You go and you say, I'm registering for financial accounting. You give them your money or however it works. Immediately, a transaction happened at the school and it changed the financial condition of the school. More money, asset, cash came in. And that's not fair because this isn't a for-profit school, but do you understand what I'm saying? Actually, revenue came in. So no, every time there is a transaction or a business economic event, it alters the accounting equation. And if we know assets have to equal liabilities plus stockholders' equity, we always have to balance at the end of the accounting equation of each transaction. So guys, in this case, Chris Clark deposited $25,000 in a bank account in the name of Net Solutions. Now he's the owner. He's probably the only shareholder per se. So when Chris takes and puts $25,000 into the business, what is one thing that goes up? Cash. Doesn't cash increase? So in this case, cash goes up $25,000 and owner's equity or stockholders' equity goes up $25,000, doesn't it? Do you see how assets still equal liabilities plus stockholders' equity after that transaction? It will always balance. Next, Net Solutions paid $20,000 for the purchase of land as a future building site. What happened to cash here? Did it go up or down? It went down. But guess what? We have a new asset here called land. What happened to land? It went up. So land increased, cash decreased. But guys, do our assets still equal our liabilities plus our stockholders' equity? Do you see in this example, the only portion of that accounting equation that changed were just assets. One went up, one went down, but we're still balanced. Does that make sense? See, guys, this is why I like accounting, because it does make sense. And guys, you can look at it and think it's so hard, but we can break it down, okay? Which is why we're going to take it piece by piece. Next, Net Solutions purchased supplies for $1,350 and agreed to pay the supplier in the future. Think about this. What happened to supplies? It increased by $1,350. Did we use cash to pay for those supplies? We didn't. What's happening here? We owe them the money. What happens when we owe someone money? It's a liability. Awesome. So no, supplies increases, supplies an asset because we haven't used them yet. But now liabilities have increased because we owe them that money. We received something, but we haven't paid for it yet. But we're going to pay for it in the future. Does that make sense? Sorry, if I get too excited, calm me down. I'm trying to help you understand. And if I'm going too fast, what are you going to do? Net Solutions received cash of $7,500 for providing services to customers. What happened to cash? It increased. Now, what you're going to learn in this is that revenue, because, cash increased because we earned revenues. Revenues is ultimately part of owner's equity. That increased the owner's equity into the business. Okay? It's not a liability, so it's got to be owner's equity. So, no, part of owner's equity is this revenue or fees earned that's coming into the business. So our assets, cash increased. The fees earned, which is a part of stockholders' equity, increased. Know that revenues from the sale of merchandise is recorded as a sale. Other examples of revenues could be rent earned, which we'd call rent revenue, interest, we could call interest revenue. So know when we receive revenues, it's part of owner's equity increasing. Also, we know when we receive cash at the time services are provided or goods are sold, we record that cash and record the revenue. But sometimes a service is exchanged, but the customer promises us to pay it at another time. That's what we call accounts receivable. It's not us needing to pay someone something. It's someone needing to pay us something. So no, that's a receivable. We're going to receive something in the near future. That's an asset. So here, Net Solutions paid the following expenses during the month. We paid wages of $2,125, rent of $800, utilities of $450, and miscellaneous of $275. Remember, these are expenses to help make revenues, right? Expenses are part of an income statement. So during this month, Net Solutions used up some cash to earn revenues. They made revenues, but now we have to use money to, help pay for those or costs of making those revenues. Assets used in this process of earning revenues are called expenses. In this case, expenses include any supplies we used up, employees' wages, utilities, and some other services. The effect of expenses is the opposite of revenues. Revenues increase owner's equity. Expenses reduce owner's equity. So do you see here when we paid wages, when we paid rent, when we paid utilities, and some miscellaneous expenses? You see those are all minus signs? That used up some owner's equity, or I should say it used up cash and it reduced our owner's equity. Okay? What about this now? Net Solutions paid $950 to creditors during the month. It reduced our assets and it reduced our liabilities. Creditors are people we owe, right? So when we paid $950 to monies we owed, what happens to cash? It goes down. Doesn't our liability now go down?
Yep.
Because we don't owe all that. We now owe $950 less. Does that make sense?
Yep.
Good. How about this? Chris Clark determined that the cost of supplies on hand at the end of the month was $550. Guys, remember we bought supplies for $13.50 earlier? But we don't have $13.50 anymore. We only have $550. What happened to the difference? We used them up, didn't we? We bought them. We had them available. But at the end of the month, Chris went into a storage supply closet and says, oh, we only have $550 left. So what do we have to do? We need to adjust that, don't we? It's not technically a transaction as far as buying and selling something. We'll talk later. It's like an adjustment. But we have to show we don't have that anymore. So it's an expense too. So we reduce our assets by $800. And we also show we have a supplies expense of $800, which reduces our owner's equity. Does that make sense? Now, Chris Clark withdrew $2,000 from the business for personal use. Hey guys, the whole reason Chris is working is to make money, to help provide for his family or himself. So he needs to take a dividend or a draw to give it to himself. So when he takes $2,000 from the business, what goes down? Cash goes down. Now, when an owner takes out money, it's not an expense. He's just taking what he earned. We call that a dividend or drawing. Like expenses, withdrawals are recorded in a column to the right of Chris Clark Capital. It's not an expense, it's a draw or dividend against Chris Clark. Okay? He's taking money out of the business. Do you see here Chris Clark drawing is a minus 2,000? So now he started with capital of 25. He took money out of 2,000. We've got these revenues here of 7,500 and all these expenses. But if we take what our liabilities and our owner's equity is, do you see how it still equals our assets? Assets equal liabilities plus stockholders or owner's equity. So after all of those transactions, if we put them all together, do you see in our assets, we show 3 assets? We have cash, supplies, and land. If I take the cash and we take all our pluses and minuses from those transactions, we end up with $5,900 in cash. If we show our supplies, which is an asset, we end up with $550 in supplies. When we take our land, nothing's changed there. We bought land and it's still the same, isn't it? Aren't all of our assets now at $26,450? And then guys, look at this. Our liabilities are down to $400. It's the only liability we have is an accounts payable. But then our owner's equity would be the Chris Clark Capital minus our dividends, plus our fees earned, minus all those expenses. And look at that. Our assets equal our liabilities plus our stockholders' equity. Know that after every single transaction, that's going to be the way it is. Assets will always equal liabilities plus stockholders' equity. But know with owner's equity, it gets a little more complicated. It's not just about what the owner invests or the owner withdraws out, but this is where the revenues and expenses come into play. Because those revenues and expenses either increase or decrease our owner's equity. Does that make sense? Yeah? Charles Lambert buys an adjoining piece of land to expand his golf course. He pays $89,000 in cash to acquire the land. Based on the accounting equation, what would be the effect of this transaction? Who said B? Does that make sense? Cash goes down, land goes up. Captivating Your Audience is a motivational consulting business owned and operated by Edith Cottrell. At the end of its accounting period, May 31st, 2022, Captivating has assets of $2,450,000 and liabilities of $1,180,000. Using the accounting equation and considering each case independently, determine the following amounts. How will we know the owner's equity? Won't we know it by assets minus liabilities equal owner's equity? Owner's equity as of May 2023. What is the owner's equity as of May 2023, assuming that assets increased by $825,000 and liabilities increased by $515,000? Guys, wouldn't we take $2,450,000 plus the $825,000?
Yep.
And then wouldn't we take the liabilities of $1,180,000 plus the $515,000? So if we do that, don't we know that then the owner's equity is assets minus liabilities? Does that make sense?
Yeah.
Owner's equity as of May 31st, 2023, assuming that assets decreased by 375 and liabilities increased by 60. Wouldn't it be the 2,450,000 minus 375? And then wouldn't it be liabilities of 1,180,000 plus the 60,000? Does it make sense how it will always balance? Yes, no? Am I confusing anyone? Will you tell me if I am? Because if you think it, someone else is thinking it. Okay? So guys, I'm just going to move on, and I'm sorry I'm kind of moving on, but I want to get through everything. But you can go back, and again, if you are confused, what are you going to do? You're going to go in the discussion and say what? Help me. Okay? What is the effect of each of the following transactions on the three elements, assets, liabilities, and owner's equity of the accounting equation? If an owner invested additional cash in the business, what happens to cash? It increases. And what is cash? Asset. What happens to liabilities? Stays the same. What happens to owner's equity? Does that make sense? How about this? Paid for business expenses. How do we pay for business expenses with our looks? No. What? Cash. What happens to cash? And what's cash? Asset. And expenses are part of owner's equity. What happens to owner's equity? Is this kind of making sense to you guys? Owner withdrew cash for personal use. To me, that means it's a drawing, right? So what happens to cash? And owner's equity went down too. Okay? When we purchase supplies on account, did we pay for cash yet? No. What happens to supplies? It goes up and supplies are an asset. Nothing happens to owner's equity, but since we owe money, what happens to the liabilities? Goes up. You guys get that? Okay. I'm just kind of moving on here, guys, and I'm so sorry, but I just want to be honor your time here. Okay. So no, all of these transactions are going to go through what we've already covered, how every transaction is going to affect either assets, liabilities, or owner's equity. But at the end of every transaction, we're going to still balance, aren't we? Okay. Now, Terry West owns and operates her own catering service. Here's the information for July in equation form. We show every transaction, how it affected cash, supplies, land, accounts payable, Terry West capital, Terry West drawing, fees, and expenses. Okay? What we're going to do, each increase or decrease except affects net income. So all of these ultimately affect net income except transaction 5. In transaction 5, she took money out to pay herself some personal expenses, right? That makes sense? Each increase and decrease in owner's equity affects net income. So in number 1, she received $71,800 and it showed fees were earned of $71,800. What this exercise is trying to make you look at is, what happened? Shouldn't we be able to look at the added cash and the added fees earned to know, oh, guess what? She provided some services catering for cash because cash went up and fees earned went up. Or what about the next one? Cash went down 15,000, but land went up 15,000. Didn't she buy some land? Do you see how we should be able to know based on what we're looking at what happened? Isn't that cool? So we know she purchased land for cash. Then number 3, cash went down 47,500 and expenses were incurred, which made owner's equity go down 47,500. What'd she do? She paid for expenses. Next, supplies went up 1,100, but accounts payable also went up 1,100. What happened? She purchased supplies on account. She needs to pay it later, so it's a liability. Then she paid $5,000 for her own drawing purposes. What happened here in number 6? $4,000 cash went down. And then do you see in liabilities, accounts payable, it went down 4,000. She paid off some debt, didn't she? Some people she owed. Then supplies went down and expenses went down. She must have realized she used up some supplies. So the supplies went down and her expenses made the owner's equity go down. Isn't that cool? You can look at a transaction and tell what's going on. That's the purpose of this exercise. Ultimately, what is the amount of net increase in cash during the month? It started at 40, but if we add and subtract, didn't we end at 40,300? So ultimately, it increased 300 during the month. Okay. What is the amount of net increase in owner's equity during the month? It started at 117,500, but now we subtract our 5, we add our 71.8 and subtract our 49. So it increased 17,800 during the month. Do you understand how we can see that? Okay. Yes.
Is there a difference to say like Terry West Drawing got paid on account and was the creditor? Would that go under fees earned or would that have a separate category?
Since in this scenario, she's not the creditor. In this scenario, she's the owner. And so any money she takes out is drawing.
Yeah.
That can occur in corporations. So like Nancy Shoemake can pay Shoemake CPA money as a loan. But in this case, we're keeping it simple. Okay. So what is the amount of net income for the month? Net income is going to be fee or revenues minus expenses. If our revenues are 71.8 and our expenses are 49,000, wouldn't that mean our net income is at 22,800? Right? How much net income for the month was retained in the business? What does that mean? We're going to take our net income and then look at her drawings. The difference is what's left in the business. She still is going to pay income taxes on her whole net income. But what they're asking is how much of that net income was left in the business for the future. Make sense? After transactions all get recorded, we then prepare reports. These reports that we prepare from this form here are called financial statements. We have primary financial statements, the income statement, the statement of owner's equity, the balance sheet, and the statement of cash flows. Guys, those are the 4 primary financial statements we're going to do. The income statement is really simple. Revenues minus expenses. That's it. That's it. Don't make it confusing. Revenues minus expenses. The statement of owner's equity just shows the changes that happened from the beginning of the period to the end of the period. So it basically shows the beginning balance of the owner's equity and what happened during the period, what revenues came in, what expenses went out, and what drawings went out, and if any more capital was input into the business. The balance sheet is the accounting equation. What's the accounting equation? Assets equal. That is the balance sheet. That's what the balance sheet is. And the statement of cash flows is just going to show cash in, cash out. Okay? It's going to show how much happened regarding financing activities, how much happened regarding investing activities, and how much happened regarding operating activities. Think of a balance sheet as a snapshot. On December 31st, the company will say, here's where we stand. Here's what we have in cash. Here's what we owe. Here's what our assets are. But guys, do you know January 1st, it could totally change? Do you see why it's a snapshot? It's just a moment in time. Okay? So when we think of those four financial statements, the income statement, which is revenues minus expenses, it's hard to see this because it's kind of small, but the revenues, fees earned are $7,500, expenses are $4,450. Our net income there is $3,050. Our statement of owner's equity shows what was invested by the owner, what the net income was for the year, because that net income is ultimately all the revenues and all the expenses combined together. And then how much drawing was taken out. Our balance sheet shows all our assets equal our liabilities plus our owner's equity. And then our statement of cash flows shows the cash in and cash out. So in operating activities, the cash in were the fees earned. For expenses, the cash paid to expenses and to creditors are the fees cash out. They bought land, so that's part of investing activities, right? And financing activities were about her putting money in the business and then taking that drawing out. Four financial statements. Guys, you're hearing a ton today. This week is really important to grasp it and to spend some extra time on this so you don't get behind. No, I don't know why I put that in there twice. No, the income statement is all about revenues and expenses for a period of time, generally from January through December. The revenue recognition principle states that we report the expenses in the period we earn the revenues. We also call that the matching principle. Net income can also be called net profit or earnings. Okay? Just know there's some words that are intermixed. If the expenses exceed the revenues, we've got a problem. Houston, we got a problem because you have a loss. And companies can't handle losses for long because they need more capital going in order to handle those losses. The statement of owner's equity reports the changes in owner's equity for a period of time. The first thing you have to prepare is the income statement, because you need that net income to prepare the statement of owner's equity, because you need to plug that in there. But you need the owner's equity ending balance in order to do the balance sheet. Do you see how there's an order in preparing these financial statements? So the owner's equity is prepared before the balance sheet because the amount of owner's equity at the end of the period gets reported on the balance sheet. Because of this, the statement of owner's equity is viewed as the connecting link between the income statement and the balance sheet. The balance sheet is just like the accounting equation. Assets equal liabilities plus stockholders' equity. Then the statement of cash flows talks about only increases and decreases in cash, but we split it into those three sections: operating activities, financing activities, and investing activities. Operating activities is a lot of what a company does, why the company's in business. Financing activities are about increases in capital, decreases in capital, or owing money or paying money, loans. And investing is the purchase and sale of assets, long-term assets. So you start with the income statement. The income statement happens by the revenues and the expenses, is the net income. We need to then know what that net income is, because that's going to affect the statement of owner's equity, because that net income increases our owner's equity. Think of net income as all the revenues minus all the expenses is net income. Then we need that statement of owner's equity in order to prepare our balance sheet. Does that make sense? Which financial statement would the owner want to review if they're interested in the company's sales, expenses, and net income? Revenues minus expenses equal net income. We see that on what statement? The income statement. Exactly. The income statement for the month of February indicates a net income of $17,500. During that same period, the owner withdrew $25,500. Would it be correct to say that the business incurred a net loss of $8,000? No. Isn't net income separate from what the owner takes out? So the net income is $17,500. Okay? Net income are revenues minus expenses. Period. That's it. Okay? It's helpful, guys, to have little sheets of paper on the side and write out the accounting equation, so you know that's the balance sheet. It's helpful to write out income statement, revenues minus expenses, and then the statement of owner's equity, beginning balance, plus revenue, plus any capital contributed, minus any drawings, is the ending balance. Does that make sense, guys? Okay, we got to get going here. So basically, what I'm going to do is I will continue to will put this online, and I will also put the lecture for, we've got really close to the end. But these problems just help you continue to learn what we're covering in chapter 1. So what you're going to do, guys, is for chapter 1, you're going to work on the homework together, and you're going to take that quiz by Monday night. You have my phone number. You've got my email. You can put questions in the discussion. If you have any questions at all, please email me. Take care, and I'll see you next Wednesday.